Well, the news cycle has started for 2024 with predictions of what's going to happen to our housing markets, inflation and interest rates. And there are already some clues in the news that this week Dr. Andrew Wilson and I are going to discuss in our regular Property Insiders chat, including what the latest inflation figures showed, what retail figures have showed. Are interest rates really even making a difference? Because boy, are we spending. And we're also going to have a look at the latest dwelling approvals to see if there's any way we're going to build enough dwellings to keep up with demand. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. Throughout 2023, our housing markets continue to defy the expectations of many. Despite 13 interest rate increases over the couple of years by the Reserve Bank, property prices not only stopped falling in 2023, but they've kept rising ever since. Sure, strong migration and fewer properties for sale put pressure on house prices and rents. So what's going to happen to inflation, to interest rates in our housing markets this year in 2024? There are already some clues in the news that came out in the last week, which I'll want to explore in this week's Property Insider chat with Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yeah, good day, Michael. And it's early days, of course. We're only, just into nearly the third week of the year. And a lot of the data that is coming through, particularly the ABS data, of course, is looking at November. But nonetheless, there are trends that are emerging, and we'll discuss them today.
Well, the first one is, let's talk about housing approval. It's clear that we've got an undersupply of dwellings for sale and to rent. And with immigration surging, we're just not delivering enough new dwellings to meet demand. Now, we know the government's keen to build 1.2 million new dwellings in the next 5 years. Well, they're not going to build them, but they want somebody to. But an increase in the supply to fix the housing shortage, I can't see that coming in a hurry. So what did the latest building approvals show, Andrew?
Well, look, slightly interesting, Michael. Of course, we've continued that downward trend. Those predictions by the government are proving to be very heroic. I think they've already missed their predictions for this year. But of course, they say they are aspirational forecasts. So they were just sort of saying, well, this is what we hope happens, but we're not guaranteeing it to happen. And as you said, it's not the government that will build these houses, it's the private sector. And the private sector has really been under pressure for a number of reasons over almost the past decade to supply Australia with adequate housing. And of course, we know all those, the reasons why: planning restrictions, green tape, red tape, and of course, recently high house building costs have made it even tougher. So it's really a supply side problem, in my opinion, rather than demand. Demand's really been quite stable going forward. Our migration numbers stopped during COVID with lockdown, and they've picked up again. But the numbers coming in terms of permanent migrants, are around about the same as what we've been bringing in. I think it's a little sort of misleading in a sense to look at the demand side in terms of what's causing this undersupply of property. It's just clearly we just don't have the resources, the capacity, or the initiative in a lot of respects to build enough homes. So we've seen over the past year a continued downturn in terms of homes that have been approved. Of course, we did have a spike as a result of the previous government's home builder initiative, which brought forward a lot of demand. But since that activity was completed, we've seen those trends continuing to fall. The latest data, Michael, which I think is quite interesting, gave us actually 2 months in a row of higher building approvals. So the ABS data for November showed overall home building approvals nationally seasonally adjusted up by 1.6%, and that followed a 7.5% October rise. We've sort of seen this roller coaster pattern of activity over the months in 2023. For building approvals, up 1 month, down the next month. And this is an early sign that maybe the trends are stabilising. Again, it was units that drove that increase. Units are up 6.7%. Houses were down 1.7% over the month. Victoria was the top performer, up by 7.8%. Again, it's the unit market that really is starting to provide a sense that maybe we've reached the bottom of the cycle. And we know that unit approvals obviously take longer to come through the system. Notwithstanding that, of course, it means that they'll take longer to actually become effective in the real world in terms of getting a key in a door. But nonetheless, 2 months in a row with higher approvals, even though it is being driven by apartments, is an early sign perhaps that we're reaching the bottom. but we're still well short of our needs. And certainly we can continue to say that our supply line is causing our housing markets to be chronically depressed. But those quarterly trends are certainly now looking like they're steadying, but we need some more data, of course, to validate that.
Well, as we say every time we report on this, just because there's an approval granted doesn't mean that something is going to come out of the ground. Much more likely for houses than apartments, where apartments in general need pre-approval, and the construction cost and development cost at the moment is probably prohibitive for many of the large developments, where end values at the moment aren't enough to make those projects financially viable. Of course, they will in due course be built, and that puts an inherent value in established apartments. There's that built-in value that's going to go up over time. And we also look at retail figures to give us an indication of, I guess, the big factor that's going to come later this month, the inflation figures. And we're again looking backwards, as you said at the beginning, because we've only got the November figures, and that's clearly skewed with early sales that happen not at Christmas time anymore, but with Black Friday and the other days around it. So what's the latest retail figures showing?
Well, certainly they debunked a lot of negativity in terms of what's happening with consumers. We've had a lot of commentary, even from the ABS, which really should be a little bit more objective in how they interpret their data. But they've been saying that consumer spending through retail sales has been down, that these were signs that interest rates were affecting consumption or consumers, and it sort of worked into those questionable polls that we see about consumer sentiment. There was even some predictions that November would be a flatter month, not as good as it usually is. So I've been waiting for these sales to come through. It was interesting, and we did discuss this previously, Michael, that there was the similar narrative happening in the US before those Black Friday sales came through. There was a lot of predictions that the US November sales would also be a little flatter because of higher interest rates. Well, that's all proved to be more nonsense. Economists continue to get it wrong. It's almost giving us a class of wrongness that's becoming established in terms of their interpretation of or their forecasts for the economy. It was a very strong month, November, Michael. Retail sales up by 2%, which is a very big number. These are seasonally adjusted, up by 2.2% over the year. But that's the highest monthly increase, Michael, for 2 years since we were getting those higher numbers through COVID. So a very big number. Certainly no sign there that higher interest rates are constraining consumer activity. In fact, in the reverse, this is looking like stronger consumer activity. Of course, it did follow that fall of 0.2% over October, which some, probably not as many as I would have thought, were showing those, as I said, those predictions that higher interest rates were curtailing consumption, consumer demand. But of course, those big numbers were driven by those annual Black Friday sales. So what's happening, of course, and the ABS has conceded this, that they have to change their seasonal adjustment models to account for what's now the strongest retail month of the year, which is November, courtesy of those Black Friday sales. People put off their October sales waiting for Black Friday, and they bring forward their December Christmas sales and undertake them over the Black Friday period. So a very big number, no validation there at any level that higher interest rates are constraining consumption. These are big numbers. And as we continue to point out, Michael, even though we've seen some flattening in the monthly growth of retail sales over the year until the latest data, which was in November, the numbers are still well in excess of where they were pre-COVID. So we're still spending at higher than the levels we did with all that government money in our pockets as a result of the COVID stimulus packages. So regardless of not the strength in monthly increases, we're still at extraordinarily high levels. And we point out, of course, those that look to the data say, well, this data is inflated by inflation, of course, because it's value of sales, and also by high levels of migration. But even considering that, retail sales numbers over 40% higher now still than where they were at pre-COVID levels. So even if you discount them for inflation and for migration, they're still very, very high numbers, and really can be no justification that those that are looking to, I guess, substantiate that higher rates are doing their job, that retail sales are falling or or consumption is easing.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. There's no doubt some people are going to be watching this and saying, hey, he doesn't understand. I'm hurting. My rent's gone up. My mortgage has gone up. My cost of living has gone up. And there's no doubt that some people are hurting from this, Andrew. But rising interest rates only affects a small percentage of the population, probably around a third in some ways. So therefore, as you keep saying, they haven't had the desired effect, and inflation most likely has come down over the last little while for reasons other than interest rates. Now, of course, that's one of the things we talk about regularly also, because we're interested to see what the Reserve Bank's going to be doing when they get together in the first Tuesday of February. We're going to be getting the quarterly results of inflation at the end of the month, a couple of days before their meeting. But we did get the monthly November figures out recently. What did they show?
Well, November numbers again, another big improvement in the headline inflation number, down from 4.9 to 4.3% over the month, Michael. I think going forward that there'll be much more focus on these monthly numbers than the quarterly numbers. I mean, what's the point of looking at a quarterly data set when you're modelling a monthly interest rate decision? It's like, well, who cares what happened 3 months ago? But of course, that followed the previous month where we saw the CPI fall from 5.6 to 4.9%. So the trend continues. There's some interesting insights when we look a little closer at the data. This, of course, is headline results that we're talking about here. When we look at the underlying inflation rate, which excludes volatile items such as food and fuel, we also saw a fall now down to 4.8%. And of course, underlying inflation is the preferred measure of the Reserve Bank. But you've got to understand that the target for the Reserve Bank is 2 to 3%. So we're still double the target for the Reserve Bank at the current result of 4.8%. When we look at the significant contributors to the headline inflation rate, again, it was housing up 6.6%, which was actually a rise compared to the previous month. So there's no real relief for housing costs. And of course, in our CPI, that measures rent, and that's all rent, not just asking rents, and of course, house building costs. So we'll have a look at house building costs next week, the latest data there, but certainly contribution of housing to the CPI is not easing, and food was also up by 5.3%. But really, the factor that's pulled the inflation rate down over the month and pulled the inflation rate really down since its peak was, again, the cost of fuel. Transport costs were they rose by only 2.3%. And for the first time in a long time, they were not a major contributor to the increase in prices over November. They were up by 5.9% over the previous month and up by just 2.3%, Michael, over November. So you can see where the dip in inflation has come from. It's interesting, My Housing Market's done a lot of research on the relationship between price of oil and inflation. And when we look at the peak oil price of a year ago to where it is now, that's the US dollar per barrel value, we see that that's fallen by around about 32% from its peak. And it's interesting when we look at the inflation rate, Michael, guess what? It's fallen from its peak last year to where it is now. Yeah, you guessed it. It's the same. It's 32%. So the fall in inflation has certainly tracked the fall in the price of oil. When we chart these two factors, because of the lagged impact of changes in the price of oil to what we see at the Bowser, it's not exactly one-on-one, but when we do look at the peak to current position, it's quite remarkable that it's actually the same and almost the same. Just shows you how strong that relationship is to our inflation rate to the price of oil. It's the same in the US. As the price of oil falls, so does our inflation rate. We've just got to keep our fingers crossed that that doesn't start to increase again. Unfortunately, there's some more ructions happening in the Middle East. Not so much the issues in Gaza and Israel, but now it's becoming issues in Iran, Iraq, and issues in the Red Sea. So that may cause higher oil prices, and that will mean a tip up. Unfortunately, will likely mean a tip up in inflation if that relationship holds, which I've just discussed. But I guess the big picture is that, well, did we really need to increase interest rates, Michael? Because it's just about falling oil prices, the dip in inflation, which would have happened regardless of interest rates.
Well, that's an interesting thought. So have we all suffered unnecessarily? Well, we'll be back each week because now that we're into the new year, there's going to be continual reports coming. So look forward to catching up with you next week for the regular Property Insider Chat.
Thanks, Michael.